In this video, we will explore algorithmic trading, focusing on its comprehensive overview and regulatory frameworks. To understand how this works, you can think of it as an automated process where we use pre-programmed instructions to trade. Instead of a person making every choice, we use a mathematical model created by programmers that is fed into a computer. This system handles different variables like the price of a stock, the timing of the trade, and the volume being moved. Because the computer monitors the market constantly, it can dynamically place buy and sell orders based on changing conditions like the time of day or security prices. One of the biggest reasons we use these algorithms is to keep our human emotions out of our trading decisions. Since the computer follows a strict set of directions, fear or greed cannot interfere. Another huge advantage is speed, as computers can place orders much faster than any human sitting at a desk. This has led to something called high frequency trading or HFT, which allows a trader to make tens of thousands of trades every single second. Large institutional investors and big brokers mainly use this technology to help lower their overall trading costs. We also need to be aware of the risks, as many unregulated platforms have started offering these services while promising very high returns. To prevent people from being misled and to protect your interests, the Securities and Exchange Board of India or SEBI has cautioned investors against using these unregulated platforms. They have even directed brokers not to mention past or expected returns from any algo strategy. Brokers are also prohibited from associating with any platform that advertises these kinds of high return promises. As we look deeper into how these systems work, there are a few key terms we should know. First is the Application Programming Interface or API, which is a set of rules that lets different software programs communicate and share data with each other. Next is a static IP, which is a fixed internet address approved by your broker to make sure no one else can gain unauthorized access. We also use open authentication or OAuth, which is a secure framework that lets third-party apps access your data without you needing to share your private login passwords. Security continues with two-factor authentication, which we often call 2FA. This means anyone using an API must go through two layers of verification, such as a password plus a one-time password or OTP. To keep the market safe, the exchange assigns a unique identifier called an algo ID to every registered algorithm for surveillance. Finally, there is the kill switch, which is an emergency function that acts as a last line of defense. It is designed to automatically stop all trading activity if the algorithm starts to malfunction. There are important new rules coming into effect on October 1st, 2025 to make retail participation safer. These rules look at how many orders an algorithm sends every second. If an algorithm sends 10 or fewer orders per second, it is considered low frequency and does not need to be registered. However, if it sends more than 10 orders per second, it is high frequency and registration becomes mandatory through a broker with a unique exchange ID. You are allowed to share these tools within your immediate family, like your spouse or dependent parents, provided you use that two-layer verification. When it comes to accessing these tools, open APIs are no longer allowed. Everything must be mapped to a broker-approved static IP that is tied to your API key. You can use multiple keys, but you must keep your registered and unregistered algorithms separate. For security, only OAuth is permitted, and that two-layer verification is mandatory for everyone. In this regulatory framework, your broker has a very important role. They must only deal with algorithm providers they have officially checked and brought onto their platform. The broker is also solely responsible for watching over everything and handling any complaints you might have. It is important to remember that SEBI and the exchange will not entertain any complaints directly. The broker is your main point of contact for any issues. We can categorize these algorithms into two main types based on how much we can see inside them. The first type is the execution algo, often called a white box algo. In these, the logic is fully disclosed to you and you can easily repeat what the algorithm is doing. Because they are fully transparent, you can see exactly how the orders are being executed. The second type is the black box algo, where the internal workings and the reasons for its trades are not known to the user. You cannot see the logic or replicate it yourself. This difference in transparency affects how they are managed. With white box algos, the decision-making rules are accessible and easy for you to understand, so they do not require special registration. However, black box algos are not accessible to the user. Because of this hidden logic, the person providing a black box algorithm must officially register as a research analyst. Finally, there are different requirements for keeping records. For a black box algorithm, the provider must maintain a research report for every single strategy they offer. If they ever change the logic of that black box algorithm, the exchange treats it as a brand new system that must be registered all over again. For white box algorithms, these research reports are not mandatory and a change in logic is not considered a new algorithm. These layers of rules are all there to ensure that even the most complex trading systems are used safely and responsibly.